Hello, everybody. My name's Drew Demon, and I'm the Devil's Stockbroker. And today I'm going to be doing a meme stock market update just to catch everybody up with what's been going on between AMC, GameStop, and some of the other meme plays, as well as a few short squeezes that Hell's Trading Floor has been tracking. So first up, we got AMC, which I'm going to pull up the weekly chart because we want to take a look at the overall picture, which is showing us some very, very bullish signs that are somewhat reminiscent of the June squeeze that we had in 2021. The market overall for the entire S&P has been very bad lately, with a slight relief coming to the market where the market retraced back up 3% since Monday after a very, very significant 3 week in a row sell-off from the end of August. Now, the AMC market right now has been basically trading in a downward channel ever since June, and it's not seen much strength coming into it. Up until recently, we had a big pop in early August, along with the rest of the market. We had a huge rally happening at the same time as with other blue chip stocks, and AMC had announced a slightly better earnings than its previous quarters, with big improvements to its earnings, big drops in its expenditure, and overall the outlook of the company is looking better. However, we still have the problem of big debt hanging over the company's head, and that's, of course, very negative for the fundamental outlook of AMC. However, on the weekly chart, we see a couple of things that I find oddly interesting looking at the behavior of the stock going into September. Now, you guys probably have already heard about the Citadel liquidation that happened in Citadel Europe. The Citadel Europe LLP fund was marked as liquidated according to the UK government website, and that's obviously brought a little bit of excitement to the Reddit and Twitter crowd, where everybody's anticipating, oh, liquidation means short covering, right? And I can feel I can feel you guys getting excited. I can tell your appetites are wet. So I'm going to go over a little bit of the technicals just to see what things look like for AMC as far as technical chart patterns. And we're going to start with the weekly. So we of course had the big squeeze that happened in January. That was honestly one of the more modest ones, where we went from less than $1.50 all the way up to $20 on, or excuse me, a high of $12.50. The this is after adjustments, so I'm having to I'm having to kind of rewire my brain for the post split adjustment to AMC and APE. But anyway, we saw a big surge in the price that happened here, and what this created was a big crossover on the MACD on the weekly that over the long term, the stock had to spend some time cooling off. Now, the MACD did this interesting move where it was just kind of hovering over the slow line. You see the fast, which is the blue line, jumped up and then just kind of went sideways for a while until it eventually touched the slow line right here. And this was in early mid-May. And what we see is that this was right precisely at the time when AMC had crossed through its weekly 200 period moving average. That's this red line that's been tracking, trending with the price. I'll go ahead and remove some of these so that it gets a little less confusing. So you see right here, this one candle, the biggest move that happened here was actually May 13th. I remember the date very clearly, where AMC crushed through the $10 price level and got all the way up to mid 12, like 12.50 or so in a single day. And that led to a slight retracement the following week, going into the second to last week of May, right before AMC's price finally just shot through the roof, and we saw a massive gamma squeeze, short covering, and it was absolutely crazy. Now, the one thing that I remember clearly from this is what this weekly MACD was doing at the time, along with other indicators such as the OBV, for instance. If you look at the weekly OBV, it kind of like was in this constant state of trending up, maybe even slightly like plateauing. It's a little bit clearer on the daily. We'll get to that in a minute. But once the OBV crossed through that threshold where it had previously hit an all-time high, that was when the squeeze was triggered. And if you'll notice, the OBV has been doing the same behavior, just kind of plateauing or staying mostly sideways, despite downward price action. And you've probably heard me say on this channel before that usually indicates that algorithms are the reason for the sell-off and not natural selling, such as from retail selling shares into the market, because algorithms are very good at targeting low volume periods. So the low volume creates drastic price action, and it's designed to create fear in the market to inspire other real shareholders to sell the market and hand their shares over to those algorithms. But that hasn't happened, and because of that, the market has totally plateaued. The volume is basically this flat line. Now, all the entire time that this has been happening, the MACD retraced all the way down here up until we got to this phase this year in March, where the market was more or less sideways as far as the momentum goes. Nobody was really winning one way or the other. The shorts had managed to keep AMC below its 200 weekly moving average consistently from early May all the way until the end of July, and then we started to get some of that volatility back. Now, this is where things start to get really interesting for AMC. I want to draw your attention to the indicator at the bottom of the chart. This is the volume direction candles charts by JD. This is a little bit like the OBV, but it shows a slight difference in that it's showing volume candles with a moving average on a long term and a short term. It's similar to having it's very similar to having a MACD, but it tracks volume rather than price. Okay, so now what I'm drawing your attention to is the candles and this yellow line, which is a fast moving average on the volume direction candles. You can see that the squeeze brings the volume up to a really, really high place, right? Because there's a ton of volume as buyers are surging into the market, okay? Now, when the sell-off happens, you get a little bit of short-term drop, and then all of a sudden you get a little bit of green. And what's interesting to me is that the buying brings in far more volume than the selling does, but the selling creates a bigger drop in the price than the buying does. And this is because we are fighting algorithms and institutions the entire way up. So it's a really slow grind driving the price higher and higher. And that creates a lot of resistance. It's like trying to push a boulder uphill. But eventually you'll notice that this slope, this hill that we are fighting against, starts to get a little bit more shallow as time goes on. And this is because shorts they're constantly at a drain, right? Shorts that are holding onto their positions and shuffling positions around and trying to manage their risks and their books, they're constantly losing money to drift. They're losing it to short borrowing fees, and they're losing it due to forced liquidation or trying to cover failures to deliver and things of that nature. That pressure that they have to deal with on a daily basis is not something that retail has to face. Just simply buying a stock and holding it gives us every advantage because, as many people have said, I'm not the first to say this, but buying and holding a stock costs absolutely nothing to us. Shorting a stock has multiple costs associated with it, and it also creates a great deal of complexity for the short seller as well as the broker who's managing those positions on behalf of their clients. And what we can see, this kind of illustrates that in a way that you can visualize it in your mind, that initially after the first surge in the price and then the rapid sell-off, in order to get to the next phase, the next leap in the price, we have to get through a period of just crawling up the hill very slowly and making slow progress. And this, I feel like this volume direction candles charts illustrates it perfectly, that the hill has gotten very shallow, right? And then as April and May came along, we saw a big sudden surge of price. We were able to walk along this flat plateau over a period of time, and then suddenly we got a little bit of buying pressure beneath us, and we were able to make the next leg of the journey and get up to new heights in the price. And that resulted in a lot of pain for shorts who then later on had to cover those positions, and they've been they've been they were hurt severely by that last leg. Now, since that time, the price has been selling off over a very long period of time, and you'll notice that there wasn't nearly as much volume that drove this big move. What I happen to notice is that the slow moving average on the volume direction candles has slowly been catching up to where we currently are. Now, this line is almost just as flat. There's other technical indicators that I'll get to in a minute, but we've been traveling along on this plateau in the OBV, the volume direction candles, whichever indicator you want to go with, for a significant period of time. It's been basically flat ever since August of last year. And throughout all of that time, we've been selling off for a significant period of time. Now, there's a lot of theory and speculation in the following statements, but I've been paying close attention to the technicals on AMC, and since we've been in this regression channel, just slowly bleeding off price over time, we've kind of hit this bottom where AMC just it won't break through this $8 level. I guess there was a brief time when we got down this low, pre-adjustment, but the price is kind of just like we have hit a bottom. It's very clear to me. We have hit a bottom. The price just won't stay down here anymore. Every time we touch this level, AMC just cracks back through whatever ceiling it had below it, had above it, and it goes on to challenge its resistance and break through multiple areas of resistance and hit fib levels of resistance over and over and over again. It happened. It happened here. It happened here, and it happened here. Just eventually, AMC starts to break through all of those previous levels that had been holding it down. And what I just happened to notice is that the entire pattern is very reminiscent of an inverse head and shoulders. It's on a bit of a tilt. You might even be able to associate this with other harmonic patterns like three drives patterns, but in all of these cases, in each of these cases that I've studied, these are all bullish patterns where the price is attempting to drive to a lower level. It's able to do it once and then fails thereafter every single time. And even though this is far from a perfect head and shoulders pattern, I can certainly see some consistency in where AMC's price never stays lower than here, and it's consistently breaking up to newer highs and trying to escape this channel repeatedly. We had a very brief period where we did manage to escape that channel right here. And now I'm thinking that based on previous tests that AMC has made that I remember from back in the day in 2021, AMC always had to test a previous level 4 times before it would finally break out. All this is to say that I'm fairly optimistic that once AMC attempts to challenge this final trend one last time after having tested it 4 times previously, here, here, and breaking through briefly here, that on a 4th test, we will finally break through these heights and start actually seeing some natural price movement in AMC. And this coincides with several other bullish indicators, such as a MACD crossover and the volume direction candles starting to meet their moving averages here. One thing that I do need to emphasize is that AMC is fairly dependent on the outcome of its financial future in order for us to see AMC squeeze. We're going to need to see at least some capital raising from its preferred equity offering in APE. This is something that's not happening in the immediate, but it's certainly going to happen at some point in the future. So I have to reiterate it just for the sake of being transparent that APE is basically the entire this is the hope for the financial future of AMC, that APE will rise in its equity value and that shareholders will elect to buy APE through a market offering of some kind, or possibly some sort of a warrant offering that AMC will eventually be able to make in APE in order to secure capital so that they can begin to pay down their excruciatingly painful debt. Going to briefly take a look at the short exempt ratios for AMC. The short exempt stats for AMC show that there's been consistently greater than 3% short exempt ratio for the last week in AMC, with at least, yes, 3 out of the last 5 trading days. AMC traded more than 3% short exempt ratio with fairly high short exempt volume numbers. The short volume was pretty severe on the last day, with what I suspect is probably some shorts covering. The short volume includes both short buying and short selling, so this can be in both directions. But we've seen a lot of short exempt volume coming in, which indicates to me that there's not a lot of shares to go around and that market makers were struggling to find shares to borrow in order to fulfill the buying orders. Now, this is also creating some lift in the price, and we see that the SMA delta rate, that's the 5-day smooth moving average rate of change, has gone green, or up in the positive, for the first time in the last week. It's up to 2.57% since the last 2 trading weeks. Now, this is a positive change for AMC's short exempt stats, because when this starts to go green, at least above 5%, that indicates that the price momentum is finally in favor of the bulls, and we can start to see AMC try to make a bull run. The other thing that I'll point out also is that short exempt total volume has been pretty high as well. Any short exempt over total volume over 2% is quite high, and we saw that twice, almost 3 times in the last 2 trading weeks. And finally, with the price starting to challenge previous highs for AMC's post-split adjustment, $10 is a significant price level. It actually would translate to around $20 in AMC if it was pre-adjusted for the split. So I'm pretty excited for AMC. It's not certain whether this is tied to the momentum of the broader market or if it is standalone. I'm hoping that it's the latter, because if AMC is truly negative beta, meaning inverse of the stock market, or at least disconnected from the stock market, then whatever the stock market decides it's going to do, such as my suspicion that it will sell off going into next week after the CPI, PPI, and the following week's Fed rate hike decision come out, that it will cause a sell-off in the market and put further pressure on big institutions who may be short on AMC and APE. The short exempts in APE tell a very different story, actually, where APE was being extremely shorted with short exempts previously in the first week of its trading, with short exempt ratio peaking past 11.7%. The short exempt ratio has consistently been above 3% for 4 out of the last 5 trading days, with a all-time high, or with a week high of 5.9% on Monday, and the price has been consistently rising since then. So this is actually all good signs for APE as well. We have a 3.8% increase in the 5-day SMA delta rate. So this is one of my 3 major triggers, along with the short exempt ratio being high enough for me to consider it in range that checks another one of my boxes. And AMC, we already know, is extremely highly utilized, but for APE, we need to go to Ortex to find out. As it happens, when we look at Ortex, we saw that right out of the starting gate, utilization was maxed out for APE. It got shorted to oblivion as soon as it came out and started trading, but ever since it hit its maximum, these bars that you see here, which is the security lending volume, has been quickly diminishing ever since then. And what I suspect this means is that there are fewer short shares to go around, ergo institutions that are using these shorts in order to pummel this stock are running out of ammunition very quickly. And this is indicative that there is more apes holding their APE shares as opposed to selling them into the market. Institutions and brokers, at least for the time being, are not able to rehypothecate these shares because it's very early in this stock's trading history. It's likely that before any rehypothecation can occur, they're going to have to figure out where they're going to even get those shares and start cycling them around in the market. Right now, if there are more apes that are holding onto their shares and refusing to let them be lent out for borrowing and short selling, then that's going to create a great deal of difficulty for the institutions that are looking to use those lent out shares against the investors that are holding the stock. The utilization is dropping a little bit, and we may have seen some short covering in the last week just because there was a huge jump in price for AMC and APE. It wasn't a lot of covering, but it was enough to move the price a pretty significant amount, as you can see based on the chart. We'll briefly take a look at AMC's short interest data, which, as you can see, utilization is still maxed out. It has not stopped being maxed out ever since February of 2022. The short interest is still rising. The days to cover is continuously rising, and I feel like shorts are starting to really feel some pain. Failure to deliver data is not going to come out until the 15th for the previous 15-day period of August 15th through the 30th. So that data will be coming out very soon here next week on the 15th, and I'm not anticipating some terribly shocking news as far as FTDs go. The real data that I want to know is what APE's failures to deliver look like from its IPO week, and in order to find that out, we're just going to have to wait. So that's the big data that I want to see, is what do the failures to deliver look like from August 16th through the 30th for APE, because that's going to tell the story of how many naked shorts there actually were at the time that APE was released into the market and started trading on 0-day settlement. So despite what the rest of the broad market will be doing next week, which I anticipate is going to be pretty bad, I think that AMC may be due for some serious upside in the following weeks. The behavior of AMC and other meme stocks is quite disjointed from the rest of the market, and with cost to borrow being well over 25% on maximum cost to borrow, or 22% on an average basis, along with about like 40% of the float, or almost 40% of the float, being on loan right now. There's a lot of shares unaccounted for AMC. I'm shocked to find that it's still not on the threshold list, but if we continue to see this bullish momentum in AMC in the following week that we saw at close of business on Friday, then I anticipate we'll see AMC on the threshold list yet again in the near future. So let's go ahead and switch on over to GameStop. GameStop on the weekly chart is actually looking quite healthy. The downward channel that we've seen here, this narrowing channel to the downside, is shown that GameStop has quite a bit of support on the weekly down at the $22.50 level. That's post-split adjustment. We've actually had a double bottom here that played out, and we actually just barely wicked through that level during earnings week this past week as well. We nearly touched it, very nearly. We actually entered into the double bottom zone right around here and wicked up and bounced off of it very quickly on the week. So that's actually quite a bullish sign for GameStop, that this is the bottom in its short-term chart, and that we could see upside to the next set of liquidity levels here at $32 and $36 per share. The weekly chart moving averages show that we are still trading above the 200 moving average, which is, still bullish territory. We've got a few cross downs happening on the weekly moving averages here for the 20, the 10, and the 50. So there is a little bit of headwind once we get up to the $35 level. So that will probably be my take profit zone on GameStop. That's where I would be looking to take a little bit of profit off of the top, and then see where it lands after it comes out of that, zone. Once it reaches there, whether it holds it up or if it's going to retrace and find a new level of support somewhere along this ascending line of support. You can see that if we look a little bit closer to the daily chart, that we see pretty much the same story here. The only difference is that now we're trading below our 200 daily moving average. So this is, again, going to create some headwind for us around the $35 level. So anticipate that, be ready for it, and make sure that you hedge your bets if you're day trading or swing trading GameStop. The push to the upside will likely see us breaking up through um, this descending level of resistance that we have had difficulty getting through in the past. And I would still consider that this move here is a bounce off of that exterior of the channel. We only re-entered it very briefly before we bounced off of support. So this is the point where it's possible for GameStop to break through this area of resistance. I'm going to stay a little bit more neutral on it and look to take profits in this area, expecting some chop and consolidation, maybe even some retracement for GameStop to have to break through it yet again. But if that doesn't happen, if it does manage to break straight through this level of resistance and then bounce off of it one last time, then I would anticipate that GameStop could see a nice holiday rally in November, December, going towards its Q4 earnings. The NFT partnership with FTX is actually extremely bullish in my opinion. I'm pretty impressed with the evolution that Ryan Cohen has taken this stock through in the last year since he's become chairman of the board, and the direction that he's taken GameStop and the entire business is it's really amazing to see how quickly he's been able to transform the way that GameStop operates from brick and mortar to e-commerce, taking advantage of crypto and NFTs, and generating excitement outside of the stock hype that's been generated through the meme stock movement, as well as the of course, the big squeeze that happened in January of 2021. So, all that being said, GameStop looks like it's got some very nice upside to it, at least around to $33 to $35 before it runs into this zone of supply. Um, it will probably have some trouble breaking through this area. We've obviously consolidated there in the past, so I anticipate it'll be no different here. We're probably going to have to chop through it for a little while, but GameStop still has come up with many surprises in the past. So if we do end up seeing a big V-shaped recovery with a huge upside to $44, right now there's a lot of short interest in GameStop that this could backfire pretty massively for shorts that got in at the wrong time. If you look at the Ortex data on GameStop right here, I'm going to zoom in a little bit just to the last several months of trading. You can see that the short interests interestingly took jumps right around areas where the price started to climb up, and then it basically did nothing. Like GameStop was just kind of moving sideways throughout this entire period of July, and even broke up to the upside a little bit, and then short started to just cover in this area right here in August, just before GameStop started to hit its peak and started driving to the downside. And then once GameStop neared its bottom right here at around $30, that's when shorts suddenly decided to get in. And now the shorts that have only just recently entered into their positions are now like they may be green for a little while, but not for very much longer if things keep up the way that they have been. So any shorts that entered in the last couple of weeks are about they're at best they are only a few percentage basis points up in profit, and at worst they're now staring down break even and pending losses if GameStop continues this V-shaped recovery pattern that we're seeing in the stock right now. And you just look at the magnitude of how many shares are actually on loan, with 20% being sold short, 20% of the free float, excuse me, being sold short. 31.5% of the free float in total is on loan. So I attribute that mostly to the market makers who are facilitating the trading back and forth. They're holding on to a significant portion of these shares. And frankly, retail is still pretty bullish on GameStop after being gifted with the split dividend that has increased their holdings of GameStop and rewarded shareholders with a basically a tax-free gift from the company in order to increase their holdings. And while it hasn't really done a ton to change the outlook for the company in the long term, I think that it's kind of a show of good faith from Ryan Cohen that he is continuously going to reward his investors in whatever way that he can. And even as far as GameStop's business model shows, that things are starting to turn around. So the earnings per share had a slight surprise. It still reported a negative number with a drop in revenue, but the new partnership with FTX obviously created some additional hype. I feel like the crypto and NFT market is going to come back stronger once we get through this period of crypto negativity. Is probably going to take some time, probably going off into late 2023 at the earliest, but probably well into 2024 for the most part, because crypto has yet to hit its bottom, in my personal opinion. But that is again just my opinion, and I don't normally pay um, too much credence to the broader crypto market, since it's I would say 90% speculation and 10% logic. But yeah, overall, GameStop, I'd be looking to take profits once it breaks through to the $33 level, and then wait to see how it reacts to resistance at 34, 35. Just make sure that you are managing your risk, because things can turn around very quickly. The other thing that I will point out is that I do have this date range marked out here. If y'all were able to catch my conversation with Trey last week, where I spoke to him on the phone, um, there was some significant dates thrown out on the T90 um, syndicate account reconciliation. Excuse me. This is a theory which I am still investigating and don't really have a concrete evidence to support, but I am cautiously optimistic and waiting to see what happens to GameStop starting on the 20th of October, because this is a date of significance, or at least that area is a date of significance, where after the split dividend, according to this theory, that any investment bank or major institution that was net short on GameStop, that was unable to cover the dividend costs, would be have their account placed in syndication and placed in the control of some large investment bank or a major institution or a collection of institutions, which will unemotionally and unequivocally cover their obligations at a time no later than the 90th day from the point that the syndicate account was created. So this is according to some other filings that I'm going to investigate in a separate video, but I am pointing this out, that 90 days from the date of the split is a date of significance that I'll be paying very close attention to. It's not something that I'm saying like buy it or hold it till then. You should do whatever you want and whatever is right for your risk management strategy. But I'm just letting everybody know that it's something that I'm paying attention to and I'll be digging into in the future. And for the record, this is something that also has some significance to both AMC and BBIG, which we will get to next. So BBIG is the other stock that I have been paying a lot of attention towards, especially with, as you saw, the interview that I held with Eric Finman, the CEO of Zash Global Media, who is hopefully going to be acquiring Vinco Ventures in the near term, sometime between the next 30 to 90 days, hopefully. And that's just based off of estimates of when this court situation is going to be resolved between the current acting CEO of Vinco Ventures, John Colucci, and once they settle things between him and Ted Farnsworth, the chairman of the board for Vinco Ventures and Zash Global Media. In the last several days, we saw some very interesting price action with BBIG. Specifically, what I took note of is that after a big sell-off and then a huge spike going into once we came out of our halt that occurred starting on August the 4th and then ended on the 16th right here. The halt, or the T12 halt from the exchange, that was basically pending whatever the hell was going on with the court action against Vinco Ventures and the Farnsworth Group, just all of this crap that was started by John Colucci. Honestly, has just thrown a wrench in absolutely everything and really, truly well and screwed up the charts. But I've noticed a couple of things, namely that things are quite skewed, but I'm beginning to see what I believe may be a diamond bottom pattern in BBIG. It's a very odd harmonic pattern that tends to happen at the bottom of long sell-offs in charts, and you'll typically see them along with a falling wedge, such as what we have currently with BBIG. Notice that this falling wedge that we've had on the stock for the last, I'd say since like the last 8 months or so, BBIG has been in this falling wedge that it tried to break out of during that big volatility spike as soon as we came out of the halt. And then we've since fallen back down to the bottom, to the $1 price level, which we know is a significant zone of demand for BBIG. Now, there's a lot of factors still holding BBIG down. The court case in particular is perhaps the biggest one, but we all still believe that the designated primary market maker, Susquehanna, may also have incentives to continuously hold down BBIG's price. And we know that they have a history of targeting retail in the past. They actually make a point of speaking to how stupid retail investors are and what easy targets we make. So I have no doubt that Susquehanna, being the designated primary market maker for BBIG, is certainly doing whatever it is they like to do in order to keep funneling money into their bank accounts at the expense of retail. So they have no incentive to see BBIG succeed, but I have a feeling that they are starting to lose control for a couple of reasons. Let's start here with the short exempt data on BBIG, which you can see there's a lot of red on the chart right now. The biggest dates that are most significant are following the run that started on August 16th, right after we came out of the T12 halt. We saw massive surges of volume and in equal proportions, significant short exempt volume as well. We had 3.9% on the 18th, 4.3% on the 19th, and on the 22nd, we saw 8.45% short exempt ratio. All of these are extremely significant numbers where the price had been rising but then got hammered back down very quickly, I suspect, by all of these major short exempts. And this is all market maker activity. The market maker dictates where these short exempts come from. They get to decide when they get to use them, and all they have to do is justify it later, only if asked. But as far as the market maker goes, they really have free reign to use this as often as they want. And you'll notice that it always spikes up on up days, and it goes on for a significant period of time as the market trends back down. So BBIG was absolutely being hammered down all through the first 2 weeks of trading as it came out of its halt, and then now the short exempt volume has kind of relaxed back below 200,000 shares short exempted for the last couple of weeks since then, but the short exempt ratio remains rather high. So this is certainly tied into the amount of volume that's coming into the stock, the amount of shorting that's going on, and all of it really just speaks to the price hasn't really been decided where it's going to go, and certainly market makers and shorts are trying to hold it down and take advantage of any downward price action. The last trading day of the week, the 9th, was the probably the most exciting one. We had hit a high of $1.04 and we closed at $1 precisely. The short exempt ratio almost reached 6% on very low volume comparable to the earlier week. So this indicates market makers are starting to lose control, and that's just my interpretation based on history of what I've seen in other squeezes before. And for just that one day, we saw the 5-day simple moving average of the delta rate go green at 2%. Ideally, we want to see this hit 5% with the price pushing up a little bit higher. As long as we can see the price starting to challenge those new highs and we see BBIG going to somewhere in the range of $1.10 or $1.15, ideally 15% is the perfect ideal scenario. But as long as BBIG is challenging those upper prices at 110 to 115, that is the kind of price action that we're looking for to see shorts start to feel the pain and market makers have trouble keeping up with the buying volume. This is probably going to happen naturally as news of a merger starts to circle back through the market, which we have seen, such as with Eric Finman showing up on Fox Business News in just the last 2 weeks. He spoke with Charles Payne, which gave some great attention to the stock. It brought it back, and of course, it sold off during the entire interview. But nevertheless, I'm looking for BBIG to continue challenging these highs at 110. This is a significant area of resistance that we've been struggling to break through since we came back down from that big move that we had in mid-August. So we've touched it 1, 2, 3 times, wicking through it each time, and then getting hammered back down. So we're getting another wick right now. We have to wait and see what next week will look like. Hopefully we'll see BBIG print another bullish candle and we can challenge this level one more time and possibly break through. Ideally, what we need to see is a close above $1.05. In the long term, the scenario that I'm basically most looking forward to is just to see merger announcements come out for BBIG sometime before October. This is pretty much the date that everybody's watching because we have a huge gamma ramp that's focused in on October 21st. This is just it's significant just because of the amount of options that are expiring on that particular date. It's not a massive amount of the float, but it is significant enough that it is building up some attention. A date that's even more significant than that, though, is January 20th, which we see 2% of the float alone is concentrated on the $2 strike for January 20th, 2023. So it is my hope that BBIG will challenge the outer bounds of this descending wedge before the end of September, and then we may be able to see a breakout going into October. The earliest that I would anticipate any news of a merger to come out would be sometime in October, but that's really early. So things can drag out much longer than that. So I'm going to continue being patient. Options is something that I would be very careful of with BBIG. You are trying to fight a market maker right now who is in their all of their money is being made by just bleeding out retail traders who are buying call options. If there's any call option that you might want to think about buying, if you're going to buy any of them at all, and please keep in mind this is not financial advice, but if you're going to select any option, I would stick to in the money options. The 50-cent strike for January is honestly the most ideal because a merger, at least merger news by that point, will be received. Will be a little bit more clear on the outlook and the roadmap for BBIG. You'll give yourself plenty of time in terms of your theta, and the price being in the money will give you plenty of intrinsic value in your options so that you won't lose too much of it if something changes and you decide that you want to exit your position. And as well, by buying a deep in the money call option, you are adding to gamma potential on the stock by increasing the volatility on those lower options, those lower strike options, and increasing the amount of leverage on BBIG to the upside. This will also put pressure on market makers to hold on to a basket of shares because anything that they sell in terms of in the money options, they will need to at least have some inventory of shares that is available to cover those at any point that those go in the money and they appear to need to have to deliver those stock. Moving on to the next couple of stocks, I'm going to wrap it up with some of the other stocks that Hell's Trading Floor has been tracking, starting with Revlon, the makeup and cosmetics manufacturer. Interestingly enough, this one's come back up on the radar. They formed a double bottom with these two deep wicking candles here that broke down to the downside below $6.30 and hit lows of $5.83. The significance of these price levels is that now this has created a double bottom pattern where we can see potential upside for this stock back up to previous highs. This is just how double bottom patterns tend to play out. And we've seen this consolidation for a significant period of time where the stock has tried to break down into these lower levels and then just bounce straight back up. And bears have just struggled the whole last couple of weeks to push the price down below this level. Keep in mind, Revlon is still an extremely risky stock to be playing. The overall situation with them is that they are going through bankruptcy settlement right now and a big restructuring of the company. So that is still pending right now. Revlon does appear to be fighting because their creditor, they have stated, was malicious in their terms of the agreement, and that they're basically saying that it was designed so that Revlon would never be able to pay back the debt, and that the company, it was part of some hostile takeover scheme. Whether or not that is true will have to be decided in the courts, but the long and short of it is Revlon is in bankruptcy right now, and unless they can get something to change fundamentally with the company, that's going to continue to be a weight on its stock price. The only thing that really seems to give Revlon some strength is that there's quite a lot of hype from social media. The short interest in it is extremely high, and shorts haven't really been making a whole lot of money on it. They've been getting punished repeatedly, where over and over again, short covering and big announcements such as the bankruptcy loan that Revlon received on the 1st of August suddenly shot the stock price up and liquidated a whole bunch of shorts, smashing all of their stop loss levels and sending the price to new heights, which have, if you'll notice, been consistently creating higher highs, and that's quite interesting. And you'll notice that every single time that this has happened, Revlon's actually been creating lower lows, and you'll notice that we have bounced off of once again another level after forming a double bottom pattern. So here we had that situation just occur here, and now we've had it happen again right here, bouncing off of another area of significant support. And now we have this big green engulfing candle the very next day, which is showing that there's some strength here. So this play may not yet be done. But of course, it's extremely risky. So I really want people to be careful here and not to treat what I'm saying as gospel, because after all, this is a bankruptcy case. Okay, this company is in bankruptcy. So the chances of something happening that could fundamentally shift the entire thesis to the downside, or basically cause the bears to win by default and the stock goes to zero, all that can happen at a moment's notice. But you know what? Just because of one final sign to me that this is something that I need to invest in, I can't deny I can't deny the validity of the price closing on Friday at $6.66. Like, for me, that's too perfect. I can't look away from it. So, you know what? That's enough for me, and I'm going to be looking to see Revlon re-challenge previous highs in the next couple of months, to test $10, possibly even $11 once again. We'll see what happens if we manage to touch this liquidity level again, or if Revlon even um, goes up at all. But for me, the chart has been showing some historical significance every time it makes this pattern, so I'm going to use that to my advantage and a confirmation for me to enter a long position. Also taking a look at CURV, which broke down on the bull flag that I had drawn in the previous weeks. So unfortunately, that did not play out to our favor. However, what we did see is that as soon as CURV touched its support line here at these two levels, that it immediately bounced off of $4.60, and for 2 days in a row after its earnings took a massive leap back to the upside, returning to $6.50, and really doesn't show any signs of stopping. So fundamentally speaking, CURV is still having some negative earnings. They had a slight loss in their revenue and a slight dip in their earnings per share, which honestly isn't all that terrible. Financially speaking, the company has quite a bit of debt on its balance sheet that it needs to settle, and most of it is in long-term liabilities, but you can see that their annual debt is somewhere around $600 million on a quarterly basis. It seems like they are starting to get ahead of it, and the net debt is beginning to drop as they increase the company's equity. The book value per share is starting to slowly improve since the last couple of quarters. They did have a pretty rough year in 2021, but Torrid Holdings does seem to be slowly working its way back up into the green, even if their profit margin has shrunk quite a bit in the last earnings period. This is one company that, despite its despite the short thesis against it, I am bullish on the consumer cyclicals sector that CURV is a part of, um, with their offering of cheap clothes for plus size women. I think that the market here will be kind to CURV going forward, despite the ongoing recession that we're currently in, and the short position right now, sitting at around 21.5% of the free float, does seem to be in retreat as Torrid Holdings has been slowly working off its debt and getting back into a better financial position. So I anticipate that trend to continue as Torrid Holdings begins to recover its balance sheet. Moving over to Bed Bath & Beyond, I'm kind of ignoring the big volatile price spike that was caused by the short squeeze that occurred in Bed Bath & Beyond. Shorts have since jumped back into the stock near the top and helped to drive it down, along with the big news of the bankruptcy and the unfortunate death of CFO Gustav Arnulf. Despite that, Bed Bath & Beyond has started to see a bit of a bounce, and I've noticed this area of support that's been slowly getting bid up. And as soon as Bed Bath & Beyond broke down with this gap down that occurred down to around the $7 level, it got bid back up with this one green engulfing candle and has been on a tear ever since then, forming a 3 white soldiers pattern. That's 3 large green-bodied candles with very small or no top wick at all. So these are very bullish reversal candle patterns, and this is just purely based on the technicals. But it would appear to me that Bed Bath & Beyond is starting to see a show of strength, that we may actually see a breakout of this triangle that's formed on it, ignoring the volatile spikes. I'm trying to look for consistent areas of price consolidation where it spends a little bit of time. So we may see some upside in Bed Bath & Beyond going into next week. I'm not super bullish on Bed Bath & Beyond, not thinking that it's like going to shoot up to like $30 in the short term or anything crazy like that. I'm just looking to catch a short-term swing to the upside, with the MACD starting to look rather bullish with a big turnaround on a crossover to the upside, and with the RSI crossing through its moving average here. In addition to that, I can see some other bullish signs, such as the 50-period moving average serving as a form of support here and on the rise, with the possibility of making a bullish crossover here from the 50 to the 100 at around the $9 level. So if Bed Bath & Beyond can consistently stay above $9 or even start moving to the upside in quick fashion, that we may actually see a bullish crossover of the smooth moving averages here from the 50 over the 100, and that could lead us to some additional upside in Bed Bath & Beyond, possibly retesting the 200-period moving average on the daily chart. So for me, I'm not going to get too greedy here with Bed Bath & Beyond. It's a very short-term bullish position. looking to capture some profits somewhere around $12. And then the last one that I'm going to look at today is BIOR. BIOR Therapeutics is, again, one of my long-term investments that I'm holding on to for several years. This is one of my high conviction plays where I'm basically playing this stock to the upside of whatever it gets to in the next 2 to 5 years. BIOR has consistently been establishing some higher lows here on the daily chart. So I'm encouraged to see that we've had some wicking candles here that tried to break below this area of 70 cents and then immediately got rejected, pushing the price back up above 70 cents. And now we have a couple of moving averages that are consolidated right here around 75-cent area. So we are trading in a zone of demand for BIOR. Every time we spend a little bit of time consolidating here, this is when the price starts to get really it gets to get really wicky, and it consolidates for a while before it shoots to the upside. So for me, again, BIOR is a long-term hold, 2 or more years. Not really playing too many options in this one. I have some leaps for 2024 and 2023 that I'm still holding on to. All of those are in the money. And I'm basically just using that as a way to ensure that I have access to buy shares at a cheaper price if BIOR, for whatever reason, good news comes out about their OBDS delivery system that is patented for treatment of ulcerative colitis and Crohn's disease. If that news comes out earlier than expected, then I don't want to miss the boat, so I'm holding on to those call options with the intent to exercise them and get more shares. Basically just using this opportunity to buy as many shares and scale into the position over time continuously until eventually BIOR goes off and takes off on its own. So that's the update for BIOR right now. Near term, the stock is looking a little bit bullish. It keeps touching this bottom here, and it just recently had a big pop right around earnings and then retrace back down to that area of support, and it's still respecting it. So with another cross over the 100 period moving average, I'm anticipating that we may see BIOR, along with a lot of the other healthcare sector stocks, to start showing some bullish momentum going into it. There's a lot of indicators that are going green. The MACD is starting to show some return of strength with a little bit of potential for a bullish cross, although it's still early yet. The STC indicator is probably going to stay red for at least several more days, even if the price goes up or to the side. So, just be patient with this one. It's going to take a long time, but I figured I would update everybody on this particular stock since it's, for me, a bit of a meme play. But nevertheless, I'm super bullish on this company, so I'm holding this one for the long term. That's going to be it for this video. Thanks so much for watching, and I look forward to seeing you guys on Monday at the opening bell. But until then, have a hell of a weekend.